This friend of mine, he comes to me and he says, Aniruddha bro, I've been investing in mutual funds for the last 10 years and my returns are barely 6% annualized, which is probably worse than a fixed deposit, right? So why on earth should I continue investing into them? Why on earth should I keep taking this risk? Why on earth should I keep tolerating all this volatility? So I said, hey bro, show me your portfolio for a sec. So he went through his emails and he dug out his portfolio and he showed me his investment portfolio. And I was a bit surprised. You know why? Each and every fund of his was actually a top performer. And when I showed him on a leading investment return site that every single fund in his portfolio had actually delivered an annualized return of more than 11% over the last 10 years, he was surprised. He said, so how is this possible? How is it possible that the published returns from each and every fund in my portfolio is actually double digit, whereas my returns haven't been inflation beating? And that's when I told him, that's known as the behavior gap in your investments. So I told him, go back for a moment and figure out what you've done with your investments over the last decade. Have you really just stayed put? Or have you moved things around? Have you shuffled things around? Every time things went up or down? Have you made any regrettable choices in terms of going in, going out, stopping your SIPs, investing based on greed or fear? And he said, yes, these investments haven't been passive or static. I've been really doing a lot of stuff with them. That's when I sat him down and I said, hey, listen, this is known as the behavior gap, and I'm going to share with you 5 or 6 of the most common behavioral traps or cognitive biases that will work against you in the long run. So I'm going to kick this off with what, in my view, or in my experience rather, is probably the most common cognitive bias that plagues our portfolios, and that is the action bias. And as the name suggests, the action bias is basically what prompts us to do something with our portfolio. It actually reminds me of a very famous and a very interesting Buddhist meme that goes something like this: don't just do something, sit there. So that's a play on the obvious reverse, which is don't just sit there, do something. But in case of investing, sometimes it pays to just sit there and do nothing. As the legendary investor George Soros once said, if you're having fun while investing, if investing is entertaining, you're probably not making any money. So good investing is actually boring. In fact, Paul Samuelson said that good investing is like watching paint dry or like watching grass grow. But yet, our human tendency is to always act, to want to do something. And we feel that we are not always doing something with our investments. We're not moving things around, making changes. We're actually not doing a good job. As an example, consider a football match when there's a penalty shootout and there's a goalkeeper standing in front and he needs to save that goal. 90% of the time, he's going to veer to the left or veer to the right. Although the mathematical probability of the ball coming straight to him is the exact same as the ball going to his left or to the right. Now, this is a classic example of how the action bias works. Let's say markets move up or down dramatically, as they have been over the last 6-8 months. Or let's say you're sitting at a dinner table and you discover that your friend's portfolio has really outperformed yours. Or let's say you turn on the TV and wow, the news sensationalizes every single market movement. The Nifty lost so-and-so on one day, and the market cap was eroded by X lakh crores. And these are the kind of things that prompt you to actually go out there and take actions on your portfolio. And we all know that a lot of these actions end up being regrettable, they end up being suboptimal. So that's known as the action bias. Keep this in mind. For example, when you're investing in equities or when you're doing systematic investment plans and mutual funds, this is something you've got to safeguard against. Every time you hear your mind telling you, go out there, do something, remember this: good investing is boring. In fact, the action bias has a significant relevance when it comes to mutual fund SIPs, so I'm going to spend a moment talking about that. The very premise of SIPs or systematic investment plans into equities is something known as rupee cost averaging. So rupee cost averaging means every single month like clockwork, I'm going to be plowing in money on a fixed date regardless of whether the markets are up or down. And what happens here is when markets are high, I end up buying lesser units automatically. And when markets fall, I end up buying more units automatically. So this is great, right? Everyone knows we need to actually buy low and sell high, but it is our behavioral tendency that prompts us to do the exact opposite. So how SIPs work is through this basic premise of rupee cost averaging. Now when the action bias kicks in, and when you see low returns, negative returns, now a lot of SIPs have been sitting on flat to negative returns for the last 2 years. What happens is then people start stopping and starting, people start redeeming, they try and time the market, they try to get in and out at the right time, and they make a bad situation a lot worse. Now SIPs have gone through a lot of such cycles in the past where 2, 3, 4 year returns have been poor and been completely turned around over just a 6-8 month or even a 1 year period. So if you're a mutual fund SIP investor, I would sincerely ask you to guard against the action bias first more than anything else. Next in line, I'm going to talk about something known as the sunk cost bias. Now, the sunk cost bias is something which plagues us all. Over the last 15 years, I've observed first-time investors, high net worth individuals, institutional investors, even seasoned players who've been at it and investing at an institutional level for the last 3 or 4 decades succumbing to this. This is a serious cognitive bias that is so firmly embedded in our brains that it doesn't matter whether you're a novice or a seasoned investor, you will find yourself falling prey to this. I think it's best illustrated as an example. Consider that you're a director of research at a pharmaceutical company. You've been painstakingly plowing in money over the last 4-5 years into a new discovery, a new patent, and you've put in, let's say, 45 crores into this project, and there are 5 crores more that you can potentially deploy. You're very, very close to that breakthrough. However, that very evening, you discover that your competitor has gone out there, solved the problem, and patented this exact same medication, right? So that's situation number 1. Situation number 2 is slightly different. You're the same director of research in a pharmaceutical company, right? And you've got a 5 crore budget to bring out a new innovation into the market. And you haven't sunk anything into that project just as yet. And as you're about to kickstart that project, that same morning, the news comes to you that your competitor has already patented this very medication. Now, the two situations are financially speaking the exact same. The decision to plow an extra 5 crores into a project which basically is not going to be fruitful. However, the chances of you plowing in that 5 crores in the first scenario where you've already put in significant time and money into that project are exponentially higher than your chances of putting in that initial 5 crores into that project if you had not started off in the first place. And this brings to light what the sunk cost bias is all about. Every time you sink time and money into an investment, you tend to hang on to it for dear life, even if that isn't a lucrative investment anymore. So, it is the sunk cost bias that eventually ends up cluttering our portfolio with a bunch of poor performing investments. I'll give you an example. I think it was the year 2008 that Unitech was flying high. I believe the stock was trading at somewhere around 550, 570, somewhere around that range, if my memory serves me right. And then it started collapsing. We all know that real estate went through and is still going through a pretty hard time, right? And the stock collapsed all the way to rupee 5. And if I'm not mistaken, it's down to a rupee or a rupee and a half now. And the funny part is, I still come across investors who are holding on to Unitech. They're holding on to Unitech for dear life after having purchased it in the year maybe 2008 or 9, and they believe that it's actually going to go up 500-fold and they'll be able to break even. Now, this is a classic example of the sunk cost bias. I can give you several other examples, institutional examples of giants who went in and bought stocks. They became penny stocks. They refused to get out. They just held on to it for dear life. So we all need to guard ourselves against the sunk cost bias. So this is somewhat the opposite of the action bias. As investors, we all need to be balanced. We need to have a balanced approach to our investment. So while of course excessive action is wrong, it is also important to go back to our portfolios once every 6-8 months, once every 1 year, and look at whether things have dramatically changed for anything. Has a mutual fund become a long-term laggard? Has a company just started failing? Is the company that used to be really, really good earlier now losing its competitive advantage? Is the environment now different for a particular company compared to what it was, let's say, a year back? And is it going to be a long-term underperformer over the next few years? These are some questions which you've got to ask yourself, to be a successful investor. And so the only way to beat the sunk cost bias is to go back and wipe the slate clean once every 6-8 months, erase the old baggage, and look at cold hard facts. Set up a checklist, set up a structured and disciplined checklist, and continue holding on to an investment only if it checks all or most of the boxes. As the famous economist John Maynard Keynes once said, "When the facts change, I change my mind. What do you do, sir?"